Welcome to episode 37 of the Ontario Mortgage and Real Estate Insights podcast. I am your host, Steve Hamoen. Today, we're diving into the latest developments in the mortgage and real estate landscape. So, grab your coffee and let's get started. In this week's Mortgage Digest, we're covering some significant movements in the bond market that could have a notable impact on mortgage rates. Late last week, bond yields plummeted as economic instability drove investors toward the safety of bonds. This surge in demand pushed Canadian bond yields to their lowest levels in 2 years. What does this mean for the mortgage market? Well, it highlights growing concerns about the economic outlook. Poor corporate earnings from major companies, a disappointing U.S. jobs report, and the unwinding of risky carry trades have shaken market confidence. As rate expert Ryan Sims explained, investors rapidly sold off equities and other investments to repay loans in foreign currencies, driving up the value of those currencies and causing widespread losses across various markets. Ryan Sims noted, "The problem is that the chaos it creates can make for a lot of volatility, and that volatility drives people to the safety of bonds. We saw bond prices up and yields down this week, especially in the United States and Canada. This should lead to some rate reductions on Canadian mortgages, assuming we hold these levels." The Government of Canada bond yield fell more than 10 basis points on Friday alone, which was on top of a steady decline in the preceding weeks. Ron Butler of Butler Mortgages says Friday's drop in yields is likely to push fixed mortgage rates even lower next week. "The ongoing downtrend we've seen over the last 2 weeks will accelerate," he wrote on X, formerly known as Twitter. In other news, the federal government's new rules allowing certain first-time homebuyers to take out 30-year amortizations came into effect on August 1st. This change, first announced in April as part of the 2024 budget, is aimed at restoring housing affordability for younger Canadians. Finance Minister and Deputy Prime Minister Chrystia Freeland said the new rule translates to lower monthly payments, so more younger Canadians can afford to pay that monthly mortgage on a new home. However, critics have pointed out that the percentage of buyers who will be able to take advantage of the extended amortizations is likely to be limited. This is because the extended terms are only available for those purchasing newly built homes, not resales. Additionally, insured mortgages, which require a down payment of less than 20%, are restricted to home purchases under $1 million. For those who do qualify, the extended amortization will be the equivalent of reducing the mortgage rate by about 75 to 80 basis points, according to BMO senior economist Robert Kavchich. For those that are able to actually access this, it's a pretty meaningful change from a monthly payment perspective, he said in an interview with Global News. Canadian posted mortgage rates are slowly easing, a trend that holds significant implications for mortgage borrowers, especially concerning prepayment penalties. Last month, both the 3- and 5-year conventional posted mortgage rates by Canada's big banks slipped 5 basis points to 6.94% and 6.79% respectively. The 1-year rate fell 10 basis points to 7.64%. Posted rates are typically higher than the actual rates borrowers receive, which are the discounted rates after negotiations. For example, a bank's posted rate for a 5-year fixed mortgage might be 7.1%, but the actual rate could be around 5%. This difference exists because posted rates act as a starting point and a way to calculate penalties and qualifying criteria. In contrast, actual rates are more personalized and reflect the competitive lending environment. Prepayment penalties, often calculated using the interest rate differential method, are directly influenced by posted rates. The interest rate differential method compares the original mortgage rate to the current posted rate. With falling posted rates, the difference between the original and current rates widens, potentially increasing prepayment penalties for borrowers looking to break their mortgage early. Matthew Imhoff, founder of Meticulous Mortgages and an expert on prepayment penalty calculations, highlighted the impact of falling posted rates in a recent social media post. "While I love that interest rates are coming down and what that means for new borrowers, I can't help but worry about all those borrowers who have no idea where their interest rate differential is," he wrote in response to a recent reduction in posted rates by RBC. It means that anyone who got a 5-year fixed with RBC between September 27, 2023 and December 19, 2023 is in a position where the interest rate differential is greater than 3 months' interest, he continued, adding that the exception is for those with a ridiculously low amortization period. On the flip side, falling posted rates present an opportunity for new borrowers or those looking to refinance. Lower posted rates can lead to better mortgage deals and reduced borrowing costs. For our final segment today, let's talk about something that has many potential buyers buzzing with excitement: significant price discounts on homes in Ontario's cottage country. If you have been dreaming of owning a vacation home or a serene lakeside retreat, now might be the perfect time to act. According to a recent report, homes in Ontario's cottage country are seeing 6-figure price reductions. This is a substantial shift in a market that has traditionally been known for its high demand and competitive pricing. The discounts are largely driven by a combination of rising interest rates, economic uncertainty, and a shift in buyer preferences. Engels & Volkers, a prominent real estate firm in Toronto, has noted that some properties have seen price drops of over $100,000. These reductions are not limited to any one area, but are widespread across popular destinations like Muskoka, Haliburton, and Kawartha Lakes. Mike Thomas, a seasoned real estate analyst, explained that the current market conditions are creating a unique opportunity for buyers. We are seeing a perfect storm of factors that are driving prices down. For those who have been waiting on the sidelines, this could be the chance to enter the market at a more affordable price point, he said. It's worth noting that while the discounts are tempting, potential buyers should still exercise caution. Conducting thorough due diligence, including property inspections and understanding the long-term costs of ownership, remains crucial. Additionally, consulting with a mortgage broker to understand financing options can help ensure that the purchase aligns with your financial goals. So, whether you are looking for a year-round residence or a seasonal getaway, the current market conditions in Ontario's cottage country present a rare opportunity to make a purchase at a significant discount. But remember, these opportunities might not last forever, so it is essential to stay informed and act swiftly if you find the right property. That wraps up today's episode of the Ontario Mortgage and Real Estate Insights podcast. Thank you for tuning in. I am your host, Steve Hammond. Stay informed, stay prepared, and we will see you next time.